Good afternoon, everyone. Thank you so much for joining us on a Friday afternoon. Hopefully you're getting the prime seats for Senator Gillibrand after us. Very excited to be talking about crypto VC this afternoon. Obviously, the narrative is that funding has dried up, but I'm here with an all-star panel of investors who will tell you how you can still find funding in this bear market. As a journalist, I'm particularly interested in this because I feel like venture capital and journalism are pretty similar, except for the amount of money that we make. But we evaluate companies, you evaluate companies, and I'm excited to learn more about how you go through that process. So I think to start off, it would be helpful to get an overview from all of you how you look at companies differently in this bear market than you did 2 or 3 years ago when billions of dollars were flowing. So Jenna, maybe we can start off with you.
Sure, yeah, and thanks so much for having me. I think companies now are expected to have metrics associated with raises. They're expected to have a lot traction if you can have it. We would prioritize community size over like technology advancement because that kind of growth is the kind that you can't fabricate. That's the kind that doesn't that community growth is what survives through a bear market. If you have a loyal community, then you have everything.
I think fundraising can be an incredibly emotional process, and then depending on the market, right? If you have sort of bull markets, that almost becomes the primary sort of factor on how rounds come together. And that's why we've seen these very, in hindsight, hilarious, rounds of GameFi, at 100 million seed valuation raising in like a week. And the good founders, they kind of know how to play that momentum and they know how to line up other, competitive investors and these things. So all that doesn't really work anymore in this market. And if someone's trying to do that, also it's not a good practice to sort of like, hey, we're killing it here, we're killing it there, are you in or not? Like on the first email. That's just like, like you might get away with that with honestly tier 2 investors in a bull market, but it's kind of like a trust breaker as well because like just means you're implying that you're sort of this FOMO investor. And so this definitely doesn't work anymore. So it's really just about sort of, building trust and giving a few data points to follow. And yeah, now we have sort of the balls more or the powers more on our side. So it's very unlikely that you're going to get a competitive round because that's what gives it momentum usually. And we had this with a project that is raising now. It's a pretty difficult raise. They have 2 leads, but they're taking their sweet time. And they're like, how do we accelerate this? And I said, well, the only way to accelerate it is if you have credible competition for them, right? If you actually have other people that like this so much that they're willing to maybe overbid them. And then if you don't have that, that's, they're going to take their time. So that's basically where we're at now. So from our side, it's obviously fantastic because you do have much more, you just have more time. You can focus much more on fundamentals. Not to say that we don't do that in a bull market either, but it becomes much harder and it's less sort of time for that. But it can still happen that you have, very quickly a round can become competitive. There is tier 1 funds. We have a lot of capital, right? We've sort of, we know how to raise and manage capital and sort of maybe take something out when all these dog coins are the billions of market cap. And so there's definitely enough funds that have capital and that are deploying. I think we're still about 10x above the capital deployed to the last bear market. So it's actually like, if you look at it, something's like hundreds of millions of dollars in a quarter. That's a lot of money. So you can definitely raise, and you can also get to this point very quickly where you have a few of us funds that have capital, the deal gets hot, and then you come back to this very competitive dynamic, but it's just less likely now, and you have to be very, very good for that to happen. Whereas in the last bull market, you had a lot of bad projects where they got into that dynamic.
Yeah, I wanted to get a show of hands. How many of you guys are entrepreneurs? Do you have any builders here? Okay.
Nice.
So that's about half. That's good to know. The rest of you guys, maybe you're investors, and so you guys should probably network a little bit more. But yeah, I would say this is the best time to be investing. This is the best time to be building. At the end of the day, I mean, when you are building and you're thinking about raising a round, you want to make sure that you have the right fit with your investor, regardless of valuation. And so I think the investors that are around, the investors sitting here, are here because they're excited about investing into companies that are going to, again, be mission-driven and trying to bring blockchain to all different industries. And so I think there's a very high likelihood that if you are raising right now, you'll be fitting with an investor that hopefully will be a long-term investor through the ups and the downs. I think for investors right now, it is a great time to be investing. I think number one, because we have a lot more time to really sort of dig into the companies. A lot of investors right now, similar to us, I mean, we are sort of resetting what theses are interesting to us. You get to do that after a bull market to sort of see what has worked and what hasn't worked and what problems still need to be solved. And so a lot of times investors are putting out their theses on what's interesting to them. A lot of them right now are investing into the infrastructure, partly because this infrastructure likely has a shorter time to get to profitability. And so in a bear market, there's a risk that this could last, I hope not, maybe 3-4 years, whatever. And so if you invest into the infrastructure, these infrastructure companies likely will be servicing developers or enterprises or institutions and have sort of bigger average customer value and can sort of get to profitability and likely get to that next round. So there has been a lot of focus there, but I would sort of say that if you are focused on consumer, for instance, and part of consumer includes like things that are front ends to DeFi or maybe even like things around NFTs, it's still a great time to be building in that category. You just have to find the right investors that see that, and your metrics to kind of getting to that next round may be a bit different. But obviously, investors that are looking at those categories are hopefully betting on folks that maybe have done it before and can sort of de-risk getting to market. At the end of the day, I think the biggest thing right now for investors is really finding entrepreneurs that they feel very comfortable to sort of get them to that next round. And it could be metrics or it could just be a differentiated strategy.
So I know two of you mentioned metrics. Jenna, you said community engagement is one of them. I'm curious if there are specifics for the founders who are out here in the audience, what you're really looking at. Obviously, growth is going to be different in this market, that type of VC explosion that you really need to understand when startups are ready for the next level. So I'm curious, again, how that's different now and if there are specific areas that you're looking at, understanding that every product can't probably be like friend tech that sees that explosive growth in its first month.
Yeah, I think founders need to be to Paul's point, founders need to be a lot more picky about which investors they actually decide to get in with, because you're essentially making a 8 to 10 year, perhaps maybe more, commitment to partner with this investor, to grow your company with them, they'll probably help you facilitate future fundraising rounds. And I think founders would do well to not force as much information on investors. I'm a former founder. I was running a startup for 3 years. I deeply understand how not to pitch crypto VCs because my company failed. And when you've been in that many pitches, you realize that not every investor is going to be appropriate for the company that you're trying to build. And as much as we can talk about metrics and traction and growth, if you're looking for venture funding, venture investors are looking for venture-sized returns. And if you go into a meeting and you sell them on this is the growth I'm going to accomplish in this short period of time, they're just not going to be interested. Or they'll be interested, but they're going to put you up against the other founder across the hall who is trying to sell them the moon. And so that dream part, if you can have a little bit of both and say, okay, yeah, I want to sell the dream because I recognize that this is a long-term relationship. I recognize that I'm going to be in this relationship with you for a long time, and I trust that this is the founder that I think can go the distance, not the founder who can execute on the strategy that they sent me. It's team first, market second, product last. And don't get it twisted.
I mean, metrics, if sort of at a later stage, obviously they need to be good. And so, for example, this is a late stage project, but Arweave has more transactions now than at the peak of the bull market, right? So something that's actually it's not dependent on speculative cycles. You actually have a use case that's independent of sort of the financial speculative cycles. That's very, very powerful. It's very rare. So it's also okay if your NFT volumes are tanking and if maybe your transaction count is still the same, your transaction count is going up, but maybe the volume is down because the price of the assets is down across the board. So there's, I think, some nuance to it. If you're If you're earlier than that, just any sort of indication that you're actually building something that's useful for a consumer, for companies, for anyone. I think there's a very, very good book. It's not very long. It's called The Mom Test. And it's recommended reading for every entrepreneur. And it's basically saying, yeah, you can, every startup idea that you pitch your mom, she's going to tell you that it's great because she wants to be supportive. But you have to see if she actually goes through effort to sign up for your stupid app and and she tries to do that thing. And that applies to your friends and anyone else as well, right? You want to be nice in person. It's a great idea. You should do it. And so it has a very simple but very clear framework on how to really figure out whether this is pursuing sort of anything valuable. And so anything in the line of these frameworks that you can show, I found a very, very cheap, very quick way to test, my hypotheses that people want that. And that could be that you create a fake sort of landing page as if your product already existed, right? So instead of building a product for 2 years, you just create a landing page what makes people sign up and pay, right? You can still then afterwards take them to a page and say, hey, this was just a test, here's your refund, thank you very much. But if you can show good conversion on that website, right? If you're, I don't know, anything more than 5% of the people visiting the website actually paying for it, then you have a very, very strong case. And you haven't even built anything, you didn't need to raise any money, you didn't need to hire any co-founders, you just built this with a website builder, right? So any of these things where you're, as an entrepreneur, you need to be incredibly street smart. And the worst thing you can do is saying, well, I need to raise all this money so I can start. That's the absolute most red flag you can do. So really being very, very street smart and just finding the cheapest, quickest ways to sort of prove that, hey, I'm building something actually that's solving someone's problem.
Yeah, I mean, I agree with you. On top of that, I mean, I guess even before even starting reaching out and discussing with VCs, I think the big thing is really just to do your homework. It's really sort of evaluating that fit. I mean, for instance, I think there's two example categories. If you talk to investors in crypto, take a look at their fund size. I mean, if they're an early stage fund, they're probably going to be looking at things a little bit differently than, let's just say, a fund that's a little bit larger. For instance, a fund like Pantera, where we have $1.2 billion, I mean, we're probably looking for more winners, and in winners as in market size matters way more because we probably have an average, check size that's a bit larger, and thus valuations that we're going into are probably going to be a bit higher, and therefore if I'm looking for certain size returns, then exits probably have to be at least in the $1 billion range versus if you're getting into a company at let's just say a $10 million post, I might be pretty good with a few $100 million return. So I think that's one example of really sort of knowing your customer, knowing your VC, and targeting the right ones. I think the other thing is really some VCs actually only do tokens. They structure their funds more like hedge funds, and so with that angle, you may want to sort of make sure that you incorporate some sort of business model that leads to sort of tokenization versus one that maybe doesn't care as much. So I think on a high level, just knowing the parameters of the investors you're talking to. And then beyond that, I think the other 4 things that I look for is once you start talking to an investor, team, product, market, monetization. Lasse mentioned monetization already. If you can show early signs of being able to convert users, that is pretty good. Outside of that, product. I mean, if you're able to actually have a VC that uses your product, for instance, we're early investors in Amber. We were using Amber so much to do our trading, it became a no-brainer that this is a good product already, great customer support, let's check the box and see if everything else is around. And then of course market depends on the investor, and then team too. That's why when you go reach out to an investor, you go through a referral. It helps to sort of have validation that people have worked together, people know the quality of work, there's been a bit of experience working with those people. So, those are some of the things that we look at.
And I think there's one really, really, at the very beginning, very strong psychological component to, I think a good approach, because I also made that mistake, is don't undervalue your own time.
Yeah.
A lot of founders jump into something because you think you can raise money, and a lot of times it's because that's what might get you a salary, right? You're in a difficult financial position. Raising that money is going to get you at least to that place, but try to think of it as if you are, I don't know, you Elon Musk, and is it actually worth my time trying to build this product? Otherwise, I'm just wasting my own time because, you might raise money and you might be good for a year and a half, but you're going to have a lot of pressure if this doesn't work, it's just going to get worse than the position you're in now, because now you've got responsibility, you've got other people's money on the line. You're going to be stuck at least for 3 years, right? Because even if it doesn't work, you can't just give up. So at least 3 years of your time, of your life, are on the line here. And then if that doesn't work out, you've wasted 3 years of your life. Your reputation is probably, it's very hard to come up with a better reputation afterwards if you just tank the thing. And so try to almost do the opposite of where like, okay, you're really, I'm incredibly successful just as an exercise. Is this even worth my time? And if that's why, you know, second-time founders that had big exits are extremely convincing and easy to back, because they don't need to do this for the money. They have everything they want to buy, and it's usually a very strong indication that they see an incredible opportunity here that is actually worth their time. And so try to put yourself in that mindset, at least, you know, for half an hour, and then review the whole thing, whether it's actually worth it, because that's what we see a lot, that people just jump into half-baked ideas. They might get some momentum, right? Their mom says it's a great idea, their one VC friend says, yeah, cool thing, and then they're like, okay, I'm raising money for this. And then once you've done that, once you've put yourself out there, it's almost like an unstoppable train. And if that takes you to the wrong direction and there's a dead end at the end, you know, bridge that just, you shoot off that bridge into nowhere. Yeah, so that's, I think, is a lot of personal psychology you got to review before you even start this thing. Like, why are you going into this? What are your motivations? And yeah.
I think you could,
sorry, go ahead.
You should also look at whether you are the right person to build that product. Like, so you may have a really awesome idea, but you may not have the profile of someone who will actually use that product. And you may not be the right person. Like, all of those boxes have to check, where like, yes, this is the right product, yes, this is the right time, and yes, I am the right person. And to Lasse's point, like, that requires a lot of sort of introspection to say, what am I, like, am I the right person to be building this? Or should I partner with someone who may have a different experience set? That's why you usually see like a 1-2 punch of really like good founders, where they have someone who focuses in this area and someone who focuses in this area. If you have 2 business-oriented founders, very hard to raise for a software company. You have to have a technical founder, or you're not going to get anywhere.
Whenever you feel like you need an NDA before telling one about your idea, you know you have a problem, because your idea is not the valuable thing. The valuable thing is that you can build this thing very quickly and bring it to market in a smarter way than anyone else. So whenever you have that instinct of asking for an NDA, you really need to talk to yourself for a long time again and sort of reevaluate the whole endeavor. Yeah.
Paul, you brought up tokens earlier, which I think is a really interesting point, because I've talked to startups who said during the last market they would approach VCs, and if they didn't have a token, some firms wouldn't even be interested in their projects. Obviously, liquid tokens have hurt a lot of firms during this cycle. The mark-to-market specificities with tokens might make it harder to raise money for funds, or the volatility makes it a lot different than traditional venture capital. So I'm curious now, when you're evaluating companies, does the availability of safes or whether they have tokens play into your decision? How would you advise startups to think about whether a token should be part of their fundraising conversation? Paul, maybe you want to take this one first?
Yeah, no, I can start at first. I'm sure Lasse also.
I have very strong opinions about
I think I have very strong opinion about this too. Look, I mean, we've done well. We've also gotten burned. There's some things recently, I don't even know, like, through the community where you can sort of figure out where, like, yeah, we're involved with projects where you feel like you got rug pulled, right? And so at the end of the day, I mean, look, when you're in a bull market, sometimes you kind of have to fit in with and you have to decide, even with like some battle scars, whether a certain investment or a certain type of instrument makes sense for you. I think right now, I mean, I don't think I would do a deal unless I feel like I'm fully aligned, knowing kind of like what I've gone through. And so what does that mean? That means that, like, I want to be in, unless there's some sort of like regulatory reason why I shouldn't be, I want to be in the equity and I want to be in the tokens. I don't know sometimes whether the value is going to accrue to the equity or the tokens. I've been surprised many times, but I want to make sure that I am aligned where I consider equity and tokens just different types of business models. I think some are appropriate for certain types of companies, and some are not. And so, you know, when I go into it, I want both.
So our standard deal terms for seed, at least, are usually a safe plus a token warrant. And I've been in crypto almost 10 years, and a short history lesson. So in 2017, a lot of VCs allocated equity capital to companies that then went out and launched a token later. And they messed over a lot of their investors. So a lot of investors got burned in 2017 because there was no token allocation, because there's nothing that, if I'm a founder who starts a company, I sell equity, and then I decide to launch a token, if that's not in the terms, then the investors don't have an allocation in that token. Like they don't have any stake or any claim to tokens there. So the token warrant structure doesn't tie you to having to launch a token. You don't have to, but it gives the investor a protective sort of bubble that says, okay, if I do decide to launch a token, this investor is going to be taken care of, and that they are going to be a part of that journey with me as well. And so like, I think founders, especially those who have joined sort of later as the industry has evolved, would do well to understand the context of why VCs are demanding token warrants. It's not because we're all token-hungry bastards. Like, that's not why. It's because, historically, we need to make sure that we're protecting ourselves and our investor interests.
Yeah, for instance, I mean, if you're in a token-only round, founders can take that token and basically just do whatever they want with it. There's no protection in terms of...
They could manipulate the supply, they could like...
Yeah, I mean, there's no
print
protection.
more of it.
Well, you're going to find that in the, if the token warrant can be more specific, I think for us the most important thing is like whether this is a token or an equity company. First of all, there's a very, very big difference between a protocol and a company. Protocols are not companies, and there's even, I think 2 days ago, someone on Twitter again sort of conflated the two things. I think it was Flipside Crypto. It was like, well, protocols need to grow up and become companies. And like, that's so wrong on so many levels. So this confusion exists with very, very smart people as well. And there's great companies. Protocols, or the big differentiator is like, it needs to be open source if it solves a trust problem. FTX as a decentralized exchange, open source, the whole story would have lasted 5 minutes. The first person sent the money there would have seen that it goes out again, at the door, story over. Right? And so you have certain industries with very high costs of trust. And the big disruptions of blockchains there is open source infrastructure, because it becomes trustless. That is the really, really big innovation. Now there's peripheral businesses that are great, like Kraken and Coinbase, that are still old school companies that are closed source, and they kind of work, and they're not bad businesses. So even Coinbase, I don't know, they have 2,000 people, or I don't know how many they have. It's not very capital efficient if you compare that to Uniswap, right? So we tend to be more on the open source infrastructure side. And for that, you cannot create a business model in the traditional way. The only way to add any economic incentives here is with tokens. And that's regardless whether the market is flipping this way, the market is flopping that way, and it's easier to raise for you now as an equity company. And unfortunately, we've seen companies that very clearly are open source infrastructure where they're having a hard time raising the next round. VCs come in that are more legacy VCs that don't understand protocol businesses, and pushing them towards an equity sort of structure. And we've seen 2 companies go down the drain because of that. So that's also a problem, that in a bear market, most investors feel safer with equity again, just because the equity didn't reprice, right? It's all private on our books, last round, 2 years ago in a bull market, it feels safe, versus all the liquid venture tokens that we have is down 90%. And so you have a lot of VCs that don't necessarily have a fundamental conviction about open source infrastructure with tokens. They try to push you now towards equity, and that's something I'd be very, very careful about. Again, if you're a SaaS company, if you're an exchange, anything like that, if your code base is closed source, equity business, 100%. If your code base should be open source because you're creating a large trust network, then just stick with the tokens, even though it's harder to raise right now.
Yeah, I think that's right. I mean, basically, like the decision of whether to create one business model versus another, and obviously like what it sort of looks like to have a product that underpins each of those business models. And then of course, like what me and Jenna are talking about is really like the funding mechanism in terms of like how to kind of get the exposure to both.
Yeah, well, I think we unfortunately don't have time for one more question. I think we could talk about this all day, but thank you so much for joining us here today. Really appreciate it.
Thank you.
Awesome.
Oh.